Hi, welcome to the Market Alert for Monday, the 15th of July 2019. So Friday, stock surge, no surprise. Record highs as payrolls and Powell spark a bond bloodbath. So let's have a look and see what happened on Friday. Start off with the Dow. This is the daily chart, and ever since we closed back above the 200 bar moving average, prices have continued to move higher and making new all-time highs. And even on today's overnight session, you can see their prices already moving to the upside. And if we just go back to Zero Hedge and scroll up, you'll see here there's a good article here about Barclays was right. It is a melt up, and this is how the Bank of America expects it will end. So if we have a read of that, some interesting information in there as well. And that's exactly what we're seeing now, and expect to see more of this as we head up towards that sort of 30,000 level. And wouldn't be surprised at all. Not at all. The only thing that's going to stop it is if Powell decides at the next FOMC meeting he is not going to reduce rates. If he fails to do that, then we're going to see prices move lower, and I'll talk about that a bit more when we get to the implied volatility. So on Friday, the market just continued to move high. You can see there it exploded to the upside. It was already above the 200 bar moving average. Fairly quiet in the pre-market session, which is unusual, and then we see the market moving to the upside immediately. Rallying 90 points, and then coming back, finding support with a retracement, and then just gently making its way all the way up to create continuous new highs. And then overnight, again, you see prices, the buying coming in here. You can see it all here, and the futures market moving high once more. Watch prices coming back to the 200 bar moving average in the 5-minute chart before moving higher once again. At some point we're going to get a correction as well, and the reason I say this is because if we have a look at the current implied volatility, you will see that on Friday we're down at 9.96, and when we get down to the 10% level or lower, then we can expect to see some sort of correction. We're still below the average that I've got running through the implied volatility at the moment, and again, as soon as this happened, this sparks the market moving higher, plus prices are below the 200 bar moving average, which I can't get on this chart at the moment because there's not enough data. A way that Excel works, that you can only have averages on the data that you can display, and a 200 bar moving average would be no good because there's barely 200 bars on there. So nonetheless, the picture that we're seeing there is indicating this. And then what also did over the weekend was create this chart, so we could see where all of the highs were and the reactions and the lows. This is the low going back to October 17, and we got down to 7.86. The market then started to continue higher, and then eventually it fell apart. And there you can see all of these areas here. Eventually the market pulls back, and that's what we're seeing at the moment. So we've got room to continue to move to the upside at the moment in these markets. While we're here, also the 3-month yield, this is heading back. If Powell reduces rates, then we're going to see this shoot to the other side as well, which is consistent when you look at the long term, where you get the yield shooting back to the upside after they've been on the downside, where you've got the inversion. Also put a lot of stats together from this as well here, the US recessions and yield inversion and recession starting. And you can see here that apart from 1981, and I haven't got sufficient data here, this is not necessarily accurate, but the yield curve inversion in the 1982 recession was already 215 days in, but like I say, this is not accurate because this could have happened before, like we see here in the 2000 recession before it happened as well, when it was triggered. So but otherwise, the March 89 inversion, which you see here, the recession didn't kick in until 461 days, which is 1 year and 3 months. And then the following one, 2000, when it inverted, was 243 days. And then we see the 714 days, which is 1 year and 11 months for the next crash that we had after the yield curve inverted here. So the average is, as you'll see here, is 1 year and 3 months and 16 days after the yield curve inversion, once a recession generally kicks in. That's the average. So it was just to give an indication of what we could expect to see going forward, give us a bit of a timeline, but certainly fascinating stuff to say the least. So say the average is 1 year, 3 months, based upon the yield curve inverting, and then the recession following from this. The pound not doing a lot, coming back, testing the 200 bar moving average there in the 15-minute chart, and then gapping lower on the overnight, but it's already filled the gap, but not a lot going on. Wait to see who's going to be the next Prime Minister of the UK, bouncing a bit there off the lows as well. And then Bitcoin story here, the market continuing to correct. If we have a look here and just draw from this low to this high, see the market's through the 76% retracement here now as prices start to come back, and also we're at the 10,000 level. It has been below 10,000 on the overnight as well, stopping at the 76% area here and then moving lower. Watch for prices coming back in the 4-hour chart there above that 200 bar moving average. Good area there for the market to find some support. And in the 15-minute chart, you'll see all the way through yesterday the short side dominating once prices had come back. Just bring this here, keep going, so you can see where prices came back. There you go. On Friday, prices, Saturday actually, 13th, though, market coming back through the 200 bar moving average, and this was the last time it saw prices closing above to where we're currently at the moment. So some weakness there. If we look at the say the bigger picture, we're due for a correction in this as the market's moved higher since the December low was hit there. So that's the sort of area looking at 8991 and probably 9,000 area. So another 1,000 on the downside quite easily yet for this market. And that's about it, I think. Let's just have a look. Deutsche Bank managing to move back to the upside again at the moment, probably because they're getting rid of 18,000 employees, hoping to support it at the moment. And that's it for this one. Actually, it's not. Let's have a quick look and see what we've got news-wise for this week as well. So let's have a quick look, see what we've got. Nothing today. Tomorrow we've got a bit, but nothing else. There's only Tuesday, Wednesday and Thursday. Powell's out for a chit chat tomorrow evening at 6 p.m. and then Evans is speaking as well, so that's likely to boost the stock market again if he hints at reducing rates. So they're the only two worth looking at this week, so keep an eye out tomorrow. Otherwise the market has no other news except tweets from Trump. Okay, that will do it for this one. If there is anything else to report, I will let you know, but otherwise, as ever, thanks for watching. See you in the next one.